Hi, I'm Connie Whitt. I'm one of the Center Directors for Mississippi Small Business Development Centers. I am presenting to you cash flow projections for your business plan. We are able to present this at no cost to you because of the funding through the Small Business Administration, the University of Mississippi, and the State of Mississippi. This is my contact information. Connie Whitt. Again, I'm a Center Director for the Mississippi Small Business Development Center. Our email address, msbdc@olemiss.edu, and our website, www.mssbdc.org. On our website, you'll be able to see all of the SBDC centers throughout the state of Mississippi, and you can connect with the closest center to where you live. The agenda for this evening is the accounting equation, the balance sheet, the income statement, cash flow statement, financial projections for a business plan, sources and uses of funds statement worksheet, a cash flow worksheet. Those are needed to produce projections for a business plan, analyzing the financial projections, a contribution margin multiplier. Yes, there will be math, a break-even point, utilizing that break-even point to manage and run a business. A simple example. Lisa owns a $300,000 home. To pay for the home, she took out a mortgage on which she still owes $230,000. Lisa would have a $70,000 equity in her home. It might be easier for everyone to think of the equation this way. We're going to turn it around, kind of like in math class. So assets, $300,000, what Lisa paid for her home, minus liabilities, $200,000, what Lisa still owes on her home, equals her owner's equity, $70,000. So that equity in her home is very important. The balance sheet. It is a formal presentation of the accounting equation. You must have a bookkeeping system that helps the business produce this balance sheet. And as we go forward in the slides, not only the balance sheet, the income statement, and also a good accounting system can help you produce your cash flow statement. So what can be assets? What are assets? Cash equivalent, maybe you have CDs in your business, inventory, accounts receivable, fixed assets that cannot be converted to cash readily. And so what that means is you may have some fixed assets, but they may not be considered current assets. And so current assets are anything that you can sell and convert to cash within 1 year. So some fixed assets might take you longer than that to sell and convert to cash. Liabilities, accounts payable. You may owe a vendor, suppliers, and then notes payable. You may have a loan to a lender. You may have borrowed money from your grandma and there's a note payable to grandma on your liabilities. And then owner's equity, common stock. Usually we start with the amount of money that we invested in the company when we started it. And retained earnings is the sum of all net income over the life of the business, and that is carried forward year over year. So a growing retained earnings, when we look at the balance sheet, is key because that shows that you have been having net income year over year, and it makes your balance sheet strong. So I'm going to take a minute. The balance sheet, for those of you that are going to go after a loan of any kind, as well, especially to a lender, you're going to have to present a personal financial statement. That is a balance sheet. It's all of your assets, everything you own. It's all of your liabilities, everything that you owe, and the difference, assets minus liabilities, is your equity. It's your net worth, and that's your personal balance sheet, your personal financial statement. So why are balance sheets important? It is a snapshot of your business financial standing. Without this, the business owner and accountants make decisions that may have a negative repercussion on your financial standing. Without these statements, without the balance sheet, the income statement, and the cash flow statement, you are more or less flying blind. You don't know where you stand. You don't know what's going on in your company. You're only looking at it from your checkbook, and that is not a view into the future. That is not going to help you make decisions today that affects your company in the future. And that's what these statements are so important for. They keep your business owners informed about your financial standing before it's too late. It is used for ratio analysis of your business. Most of us here are familiar with debt to equity ratio. So the numbers from our balance sheet and our income statement assist lenders in looking at our assets and liabilities in order to make some business ratio analysis. Here at the Mississippi Small Business Development Center, we also have a financial tool that we can use to see for your business, how do you compare to industry standards. It also let the banks know if your business qualifies for additional loans or lines of credit. So it's a very important document. The income statement shows the company's financial performance over a period of time. It is used in ratio analysis of your business, sometimes referred to as a profit and loss or a P&L. Remember, we keep talking about some things have different names and for the same thing. This is also that case. Formula: revenue minus expenses equals net profit. The bookkeeping system for your business needs to be able to produce income statements. These statements, the income statement, the balance sheet, are very important to the management of your company. The cash flow statement is similar to the income statement in that it records a company's financial performance over a specified period of time. The difference between the two is that the income statement also takes into account some non-cash accounting items such as depreciation. So depreciation is an item that when we buy something, it depreciates over a period of time, and that depreciation expense is put on our income statement. It's mainly used for IRS rules. So the cash flow, we want to have just cash items, cash going in and cash items going out. Financial projections for a business plan. Financial projections are needed for a feasibility analysis, and it's required as part of a loan package for a business loan. It is also a good tool for yourself in that you can see how your revenues and expenses look over a year, and you can start planning. Maybe one month looks better than another. You can start planning. And again, a planning tool, balance sheet planning tool, income statement planning tool, financial projection business plan planning tool. So needed, things that you're going to need to produce financial projections or to present this package for a loan is a balance sheet beginning for years 1, 2, and 3, income statements 3 years month by month, cash flow statements 3 years month by month. So how are you going to do this? You do not have to recreate the wheel. With the assistance of the Small Business Development Center and some tools that we're going to talk about here in a few minutes, the sources and uses of funds worksheet and a 1-month cash flow worksheet, our SBDC counselors are able to help you produce 3 years of financial projections. The sources and uses of funds statement. Used to create the opening balance sheet for the financial projections of your business plan. This is basically a breakdown of how much you put up, how much the bank puts up, and the total capitalization requirements for the project. Column 1 is owner injection, how much you are putting into the business. Column 2 is the lender column, how much you need to borrow from the lender. Column 3 is the owner injection plus funds to be borrowed from column 2 equals total funds required, column 3. 1 plus 2 equals 3. Pretty simple. The owner injection percentage requirement is determined by the lender. It can be anywhere from 10 to 30%. OI, owner injection, can include things like cars, equipment, cash, deposits, inventory that are used in starting or operating your business. So here is a completed sources and uses of funds worksheet. And you can see at the top in the A section, we have these words highlighted in blue. They're in blue to show that they are just fixed assets, and mainly in the yellow where that's where we're trying to put our money for ourselves and for our lender. So we are borrowing a lot of fixed assets. And as a business owner, I'm putting in $2,000 for software. So $2,000 plus 50 equals 52,000. So for this section, 1 plus 2 equals 3, $224,800. Then the green writing, our soft assets, are working capital. And so they're things like cash, inventory, prepaid expenses, advertising could be a new sign, deposits, utilities, and organizational costs. Maybe I had to have an attorney or a CPA. It could be documents that I needed to get with the city in order to build my building or open my facility. So you can see total column 1, 34,000, total of column 2, 302,000. So the total cost of my capitalization of my project, column 1 plus 2 equals $336,000. So you can see we have a percentage at the bottom, and what the owner injected was just a little over 10%. So why was the owner able to do just 10? Because most of what he wanted to borrow is in the fixed asset column. So as we go out and borrow money, if we've purchased a home, or most of us have purchased a car, if we don't pay those loans, the lender can come and get that. A lender's not going to want to come and get your sign that says Connie's Cookie Shop. They're not going to be able to do anything with that. But if I don't pay for my kitchen equipment, they can get that. So, or if I don't pay for the building, they can get that. So the more that we can put in to borrow against fixed assets, usually the less that as an owner we have to put in projections. So as we go forward, these numbers are going to be very important for the balance sheet. This is our balance sheet. It reflects the numbers from our sources and uses of funds statement we just completed. Cash, $94,200. Inventory, $6,000. Prepaid expenses, $8,500. Other current assets, $2,500. Leasehold improvements, $75,000. FF&E, furniture, fixtures, and equipment, $97,800. Other fixed assets, $52,000, for a total of assets for $336,000. In the liabilities and owner's equity section, the loan that we need to start this business, $302,000. Owner's equity with common stock, $34,000. That's the owner's injection from the sources and uses of funds. So our total liabilities and owner's equity, $336,000. You can see, again with the accounting equation, total assets equals total liabilities plus owner's equity. So your balance sheet balances. Cash flow worksheet. Gross sales are the total sales recorded prior to the sales discounts or returns. It is useful as a measure of the overall sales activity of a business. Cost of goods sold or variable costs are those expenses that respond directly and proportionately to changes in activity level or volume, such as raw material, cost of goods sold, hourly production wages, sales commissions, inventory, packaging supplies, shipping costs, material costs on the monthly cash flow projection worksheet. Gross profit margin is a company's total sales revenue minus its cost of goods sold or variable expense. Operating expenses are those expenses that do not fluctuate with changes in production level or sales volume. This includes such expenses as rent, insurance, dyes, subscriptions, equipment lease, payments on loans, depreciation, management salary, and advertising. Net income is calculated by subtracting total expenses from revenue. Gross sales minus cost of goods sold or variable expenses minus operating expenses equals net income. So this is an example of a completed net income or cash flow worksheet, and you can see it is for 1 month. So we had 40,000 in food sales. We had 10,000 in drink sales. So our total sales, our gross sales, our total revenue is $50,000 for 1 month. Our cost of goods sold for our food is $16,000. Our cost of goods sold for our drinks are $4,000. So our total cost of goods sold, our total variable expenses, our total material costs is 20%, 20,000 or 40% of our sales. So our gross margin is 30,000, and our gross margin percentage, which is cost of goods sold divided by gross sales, so 20,000 divided by 50,000 equals 60% or 0.6. So our labor is 10,000, advertising 1,000, credit card charges, fees. Our insurance 700, our utilities 1,500, our debt service is 3,500, our equipment lease is 1,200. So our total operating expense is 23,550, and our total expenses, that's fixed, plus our cost of goods sold is 43,550. So we had a net profit $6,450, which is our gross sales of 50 minus our cost of goods sold minus our operating expenses. Again, net profit of $6,450 for 1 month. So analyzing the financial projections. So personal financial liability, I invested $34,000. I borrowed $302,000 with a personal guarantee. I have a 5-year lease at $4,500 a month, personal guarantee. I have a 3-year equipment lease, $1,200 a month, that may require a personal guarantee. So you see personal guarantee, personal guarantee, personal guarantee. When you borrow money, especially from a lender, they're going to want a personal guarantee. Usually this will be for the first 3-4 years of your business. They will still go back to you personally. So that's why, one, it's important to have a good personal credit, and as you're going forward, start establishing business credit. So personal guarantee is that you're going to have to pledge some personal asset for that loan. And if for some reason you cannot pay, your business does not make the 5-year lease, so in other words, business goes out of business, say year 2, for the next 3 years, you are still responsible for $4,500 a month. So we're going to talk about opportunity costs. The salary with benefits that you have if you stayed on your job, or you're going to do something else. So we call this return on investment. Time, financial investment, stress on your family. So your estimated positive cash flow of $6,450 for the first month of business. Your estimated positive cash flow is for how many months in 24 months of operation. So your lifestyle, your first year in business versus your third year in business. And those of us that have been in business before, you will know your first year is very tough, especially stress, because you will be working a lot. So determining your working capital needs for your startup. So you saw back there where we, on our balance sheet and on our cash flow worksheet, we said we needed $94,200. So we suggest starting your business with at least 4 months of operating expenses. So when you look back at the income statement, you see our operating expenses for the month. Now that's just our overhead. That's just our lights, utilities, our debt payments that we have every month. Total $23,550 times 4 months. That's where we got the $94,200. And if you remember, 20,000 of it I had in cash, and the other 74,200 I had to borrow from the lender. As we go forward, the following presentation is designed to give you a usable understanding of the most important financial fundamentals necessary to start and operate a successful business. As the information is presented, think about how to apply these principles to your own business or your business idea. Personal note: I wish I knew this information I'm about to share way back when I owned and operated my own small business. It would have made a lot of decisions easier, slept better, and made more money. And that's one thing most of the Small Business Development Center counselors can tell you, is that we have owned, and some of us still operate on the side, our own small business. We understand your pains, and we understand how you want to have a dream and move forward with it. Contribution margin multiplier. I told you there would be math with this PowerPoint. So in our example, we are making a loaf of bread. XYZ company sells their bread for $2 a loaf. It costs them $1, cost of goods sold. Variable expenses, same thing, that's the dollar. So 50% or 0.5 of the $2 bill, $1 goes to pay my variable expenses, my cost of goods sold, my material costs, and 50% goes to pay for my operating expenses, my payroll, my rent, my note payable. So to figure a contribution margin multiplier, it takes your gross margin in a percentage and converts it into a multiplier that allows you, the business owner, to quickly determine how much needs to be sold each month to cover your various monthly operating and fixed expenses, payroll, rent, note payable, and to make good decisions concerning the management of your business. And remember, everything that we're showing you, the balance sheet, the income statement, the cash flow statement, this contribution margin multiplier, are for you to be able to make good management decisions for your business. You've heard it said, do you want to run the business, or do you want the business to run you? So steps to creating the contribution margin multiplier. So to calculate it, first we have to do our gross margin percentage. So that's $1 minus 50 cents, my cost of goods sold, gives me 0.5, 50 cents left over to do everything that I need. And then calculate the contribution margin multiplier. So that's $1 divided by 0.5 gives me a multiplier of 2. So if my rent is $1,000 per month, how much do I need in gross sales to just pay the rent? So I'm going to say 1,000 times my contribution margin multiplier of 2 is 2,000. So that's $2,000. And so remember, I sell my bread for $2 a loaf. So $2,000 divided by 2 gives me 1,000 loaves of bread I've got to make just to pay my rent. So, contribution margin multiplier and the break-even analysis. Looks pretty good. A nice big shrimp poor boy there. So this is Mitch's poor boy example. So the average ticket for a poor boy, order of sides and a drink is $10. And the cost of goods sold, the variable expense, the material costs for that $10 meal is $4. So 40% or 0.4 of the $10 bill, $4 goes to pay my variable expenses, my bread, the shrimp, the lettuce, the tomatoes, and 60% of the $10 bill goes to pay for my operating expenses, my overhead expenses, my payroll, my rent, my note, my utilities. So determine this contribution margin multiplier. And so as we do this, think about your own business, what you're going to sell something for, and what it costs you to make that product and or service. Calculate the gross margin percentage first. So we use $1. It's easier to understand or to calculate than using the 10. But $1 minus 0.4, 40%, it gives me 0.6. And so then I calculate the contribution margin multiplier is $1 divided by 0.6 gives me a multiplier of 1.67. So if I spend $4,500 a month in rent, how much do I need in gross sales to pay just to pay the rent? So 4,500 times 1.67 equals $7,500, or 751 and a half tickets, and we figure that out by taking 75.15 divided by the average ticket price of 10. So I need to be able to produce 751 and a half meals in a month just to pay my rent. That's just to pay my rent. So how will we use this going forward? So taking into account the break-even point, how much do I need in poor boys to cover the $10,000 in payroll with a variable expense of 40%? So 10,000 times 1.67 is 16,700, or 1,670 tickets. 1,670 $10 meals to pay for my payroll. How much do I need to sell to cover my overhead expenses for 1 month? This is your break even. So remember, whether I have any customers walk in the front door or not, I have got to pay my fixed expenses, my operating expenses. So how much do I need to sell every month just to cover my operating expenses? So in our previous examples, 23,550 was my fixed expenses times my multiplier of 1.67 is $39,328.50. That is your break even. That's how much you have to do. So the break even is not good and it's not bad, but it is where you're not making any money and you're not losing any money. I call it treading water, and most of us cannot tread water for very long. So if I divide that by 39,000 divided by 10, that tells me how many meals I need to sell, I need to be able to make just to pay my operating expenses. So now, holy moly, I have a problem. How much does Mitch's poor boys need to sell to cover 10,000 payroll if my variable costs move from 40% to 55%? So we have to have a new contribution margin multiplier. 1 minus 55 cents now is costing me 55% of every dollar now to cover my material costs. So that gives me 0.45. So that gives me a multiplier of 2.23. So now, just to pay that 10,000 payroll, I've got to have sales of $22,300. So just a change of 15 cents in cost of goods sold has increased how much I have to sell just to cover my payroll by $6,000. To cover all of my fixed expenses, 23,550 times my new multiplier of 2.23 is 52,516. How can I figure out if this is happening to my business, why this happens, and what I can do? Here are some other examples of how to figure break-even point for certain industries. The first one is the liquor store. They have a variable expense. You can see here, same name, cost of goods sold, or for them, inventory, which is 70%. They have a total fixed expenses of $10,000 per month. How much do you need to sell to cover that $10,000 of fixed expenses per month with a variable expense of 70%? So 1 minus 0.7 equals 0.3. This is your contribution margin multiplier. 1 divided by 0.3 equals 3.33. So $10,000 of fixed expenses times my contribution margin multiplier of 3.33 is 33,000 in break-even point. I'm not making money and I'm not losing money. Example 2 is the lawn cutting business. They have a variable expense of 33%. They have labor and gas. They have fixed expenses, insurance, phone, loan, advertising of $300 per month. How much revenue is required from me in my lawn cutting business to cover the $300 of fixed expenses per month with variable expense of 33%? 1 minus 0.33, 0.67 to get our contribution margin multiplier. 1 divided by 0.67 equals 1.49. My answer, $300 a month in fixed expenses times my contribution margin multiplier of 1.49 is $447. That's my break-even point for my lawn cutting business. Break-even is a starting point for you. It lets you know what you need to do to cover your fixed expenses. You're not making money and you're not losing money. So in planning and thinking about your day, breaking this down to how many of whatever I need to do per month, per week, per day, per hour in order to break even. And when I do more than that, I know I'm making money. So finally, Mitch's poor boy and his family. Mitch's poor boy has maintained its variable expenses as cost of goods sold at 40%. He has hit his break-even point of $39,328.50. Didn't make any money and didn't lose any money. Look at that poor little family. Mama's had to sew patches on the clothes. Mitch hasn't had a haircut in a while. Every month for the last 2 years, Mitch's wife informs him that he needs to get a paycheck. If he's going to continue running this business, he needs to start looking for a job. Mitch and his wife determine that the business needs to generate a net profit of $7,500 per month so Mitch can get a paycheck and help financially support the family. So question, how much does Mitch's poor boy need to increase his monthly gross sales, which are currently $39,328.50 per month, in order to generate a net profit of $7,500 per month? Here's a hint. Think of the net profit as a fixed expense and use the multiplier of 1.67. So I want whoever can figure that out to email me the answer. Here we have some additional key points. Start to learn the language of finance. It is needed to understand your financials of your business, for you to communicate with your accountant or lender, for you to interact with your insurance agent or your vendors. Learn to read your balance sheet and income statement. The contribution margin multiplier is just one example of how to use your business financial information to develop key ratios that can help you start and operate your business successfully. Successful business owners are usually, but not always, good with the financial side of running a business. I might be a good bread maker, I might be a good car mechanic, I might be a good insurance salesman, but I might not understand the accounting that needs to go on to operate a successful business. And the reason we're asking you to do all this is that you have the tools necessary not only to run day to day, but to manage your business for the future. A good person to have on your team is a certified public accountant. Good information needs to go in before usable information can come out. Part of designing a business model is determining your variable versus your fixed expenses. The Mississippi Small Business Development Center has counselors throughout the state for one-on-one appointments if needed for your assistance. We are here to help. We have many tools in case you're not sure about your business that we can use to show us industry information. Questions. Please email any questions that you have concerning this workshop to msbdc@olemiss.edu, and an FAQ sheet will be on our website, www.mssbdc.org. And also on that website, besides the FAQ, you'll find a lot of information to assist small businesses. And please remember to participate in the online evaluation. Again, thank you for viewing the workshop, and we look forward to helping you in any way that we can.